Hello, this is Joe Hoyle speaking to you today from the University of Richmond here in Richmond, Virginia, where I teach a financial accounting class actually downstairs in room 223, if that makes any difference. Today we're going to talk about video lesson number 1 on intangible assets. Now, intangible asset is any asset that has no physical characteristics. You can't eat it or touch it or taste it. It's intangible. There are many very popular intangible assets. There are patents, copyrights, trademarks, logos, and the like. But in this video lesson, I want to talk about my favorite intangible asset, which is goodwill. Now you might ask, why would anybody have a favorite intangible asset, and why would it be goodwill? Well, there's a couple of things that I really like about goodwill. First off, almost any company that has of any size will have goodwill. If you pick up a set of financial statements for almost any company you've ever heard of, and you go to the balance sheet and you look at the assets and you come down to where it says intangible assets, you probably will find an account called goodwill. So it's always there. Secondly, it tends to be a very large amount. It's not some small trivial amount in many cases. It's very large. So you always see it, and you always see, or almost always see, large amounts. And the third thing I like about it is most people who look at a set of financial statements really don't understand what it is. If I talk about equipment, I understand equipment. If I talk about inventory, I understand inventory. If somebody tells you that they have an asset called goodwill, it's hard to even know what they're talking about. It seems to me that this is a spot where you can gain a head start over other people. If you know what goodwill is, especially if it's always in a balance sheet and always large, then you will be better educated, more likely to be successful than other people. Now, to demonstrate goodwill, I set up this video problem. Your roommate's parents own a set of ice cream stores. They buy another store from an elderly couple and they pay for it. And your roommate is concerned about this. The roommate says, well, the building was worth $1 million. The equipment and the inventory were worth $25,000. They should have paid $1,025,000. That's what the assets were worth. But they paid $1.5 million. They paid $1,500,000. Why did they pay so much? So this is our first question. Notice that the company is buying another company. This is always the case when goodwill comes in. Secondly, they have valued the assets and they're paying more for those assets or more for the company than the assets are worth. The assumption is that any company that's a going concern, it has customers, it has loyalty, it has employees. There are just simply some advantages to already being a company. Apparently, this particular ice cream store had a great reputation. People come to it, get lots of ice cream, people love it, it draws in lots of revenue. So the fact that it already is a company makes it more valuable. Whenever the parents started to buy this, they negotiated a price not of $1,025,000, but of $1,500,000. They paid an extra $475,000 when they bought the other company. That is not at all unusual. Sometimes it's simply necessary to pay extra to get the previous owners to sell. When the parents get ready to record the new acquisition on their books, they'll add the new building in at $1 million. That's what the new building is worth. They'll add the equipment and the ice cream in at $25,000. That's what it's worth. But the question is, what will they do with the other $475,000 that they had to spend to get this other company, that they had to spend to get this great location, that they had to spend to get this great reputation, that they had to spend to get this customer base? Now, the accountant will look for any identifiable intangible assets. And those are assets that you can either separate and sell or that you have contractual rights to. So there could be some other intangible assets that make up part of this $475,000. For example, if the couple that sold it had a very fancy recipe that they had copyrighted, then possibly some of that money was paid to get that wonderful ice cream recipe. If so, that copyright should be recognized. But typically when you buy another company, you do pay extra just for the loyalty of the customers, the expertise of the management, the location and things. So any amount that they pay, in this case $475,000, that you cannot identify with a tangible or an intangible asset is arbitrarily recorded as the intangible asset goodwill. So if you go out and you look at a balance sheet and you find a goodwill account for $10 million, you know that that company has bought at least one other company, maybe many other companies. And when they did, they had to pay extra over and above all of the identifiable assets of that company in order to get the ownership. Now, why they paid extra could be for a variety of reasons, but they paid extra. We didn't know what to do with that extra amount, so that extra amount was reported as goodwill. Now, because goodwill is such a nebulous asset, we do not amortize it. Buildings are depreciated, equipment is depreciated, patents are amortized. They have a finite life. Goodwill does not have a finite life, so it has its own special way of accounting. Some part of this is too complicated for an introductory course, but the basic idea is this: the goodwill simply stays on the books until it's obvious that the value has been impaired. So if you never impaired the value of that new ice cream store, the goodwill would stay on the books forever. But at some point, because of bad luck or bad management, the goodwill, the customer loyalty, for example, or the expertise, for example, might go away. If that happens, you write the goodwill off and you recognize the loss. This is one of my favorite video lessons, and the reason is that I think learning about goodwill tells you something that most people don't know. It's pretty obvious what it is. It's the extra you pay to buy another company. But sometimes, until someone sits down and explains it to you, it's hard to understand. So when you see goodwill on a balance sheet, you now know where it came from. And really, that's the purpose of an education, to help you understand what you're seeing in the real world. Have a great day. Keep studying. You're going to make it.